First and foremost, a very warm welcome to our audience from around the world joining us today for discussion on a very engaging and interesting topic. I am Pankaj Sharma from CFA Institute, and I will be the moderator for this webinar. I lead capital market policy for India, and in my role, I am responsible for advocating policy positions on issues that affect Indian capital markets and its stakeholders across a broad range of issues. Before I introduce our speaker, I have a couple of housekeeping notes. Today's webinar is scheduled for 60 minutes, including Q&A, 35 to 40 minutes for conversation and presentation by our speaker, and then last 20 odd minutes for the Q&A session. We'll be leaving ample time for question and answer. Please feel free to submit your questions throughout the presentation. You can do so by clicking on the Q&A icon at the bottom of your viewer and typing your questions in the box. We immensely value your feedback, so please complete the evaluation survey before you sign off today. Now, it's my pleasure to introduce our speaker for today's webinar, Mr. Daniel Jim. Daniel Jim serves as a senior advisor to Chartwell Family Partners, with his main responsibility being strategic asset allocation and external manager selection. He began his career in Europe and was instrumental in supporting major European institutions' first investments into Chinese equities. He subsequently, as founder of one of the first homegrown independent investment management firms in Greater China, focusing on alternative investment strategies. Over the years, Jim has established himself as one of Asia's pioneers in global hedge fund investments. He is a multifaceted talent. For example, he has conducted due diligence on more than 6,000 funds and allocated to more than 100 funds. But it doesn't end there. Jim takes active interest in sharing his learnings with a wider set of audience. He has been lecturing at the HKSI Institute for more than 20 years on topics ranging from hedge fund to asset management, and currently, he is also a part-time lecturer at the Hong Kong Metropolitan University. He also serves as a non-governmental advisor to the Competition Commission of Hong Kong, SAR, advising on matters related to the financial services sector. Before his illustrious career began, he graduated from St. Joseph's College in Hong Kong, and Jim has earned his bachelor's and master's degree at the Chinese University of Hong Kong and SDA Bocconi in Milan, respectively. Welcome, Daniel, and it's a pleasure to have you with us here today. I'm sure that our audience will have a great experience listening to you. Without further ado, over to you.
Thank you. Very honored to be here, to be invited to give this session. First of all, I will have to stress that the approach that I'll be taking tonight will pretty much from the perspective of an allocator, somebody that is looking into algos and high frequency trading strategies, and then trying to assess whether it is the right type of investment for a client. So want to stress that I'm not really a tech guy. And so any questions related to how we can improve the technology itself, probably I may not be the best guy to answer. Another thing also is that I must confess that I may not understand the Indian financial market as well. A lot of the times the information are from the managers themselves. So maybe if there are issues particularly related to regulations or things in the Indian market, then you have to bear with me that maybe my answers will be a bit more superficial. Now, let's get it going. And basically tonight, I'm trying to approach this topic from 5 different angles. Usually, I always like to start with a little bit of a definition just to make sure that we are on the same page when we start. And then we'll obviously have to dig into the history, because all of these different strategies, come from somewhere, and there were reasons why they have been developing over the years. to today. So let's take a look at the history and what has been affecting the evolution of these algos and HFT strategies. And then, of course, we try to zoom in to look at the strategies themselves. Now, again, every time when we are talking about these kind of topics, it's just very understandable that we will not be able to cover every single strategy that is being, sort of practiced out there in the marketplace. Number one, and honestly, even being an allocator for 20 odd years, I can tell you that I don't think anyone in this world know how many different single strategies are actually out there. Because most of the time, they are being seen as some sort of a trade secret, and then not very often that, the managers or the traders will be sharing them, completely. So usually our approach when we're talking about strategies, it will start from the building blocks. So we'll cover some of the most basic strategies, knowing very well that by today, after people practicing these for years and years, if not decades, they have been, evolving into something very new as well. So every day, by definition, there should be some new addition to strategies being, sort of employed. But understanding the building blocks are very important because we have to understand where is it coming from and what was the original objectives of all of these strategies. Again, another thing, as in the hedge fund, sort of community as well, you tend to hear a lot of very sort of exotic and sexy stories about, a lot of these strategies being, practiced. But then honestly, as I mentioned a little bit earlier, nobody really knows what actually happened, right? So, it is understandable that sometimes when a story got passed on, they got exaggerated a little bit here and there. So I tend to look at things a little bit more from a simplistic way first, right? So trying to understand that, a lot of this strategy, at the very core of it, should be something very simple, something very understandable, and not something that very complex. Because as an allocator, honestly, if a manager is trying to explain to me something in a very complex manner, if I already lost them 5 months down the road, 5 minutes down the road, so to speak, after they started explaining, probably, it will be going nowhere. So it is very important when we understand strategies, trying to take it from the basic first. What are they really trying to achieve? And then we look at all the extra building blocks that they have been building on it. So what I'm just trying to stress is that HFT, or hedge fund or algo strategies in general, by definition, they shouldn't be very, very complex. The more complexity a strategy there is, the more moving parts they have, and then the more chances for the manager to get it wrong, right? HFT, just like any other strategy, is not for sure winning strategy. There are loads of traders employing HFT and still losing money in the market. You just don't heard about them. You always hear that little winning story here and there, right? So I hope that we can take that sort of more pragmatic approach when we're looking at these strategies, rather than looking at them as something, sort of winner takes all or super duper strategies that will always be making the money. And then we touch on some of the topics that are pretty much debated in the markets over the years when it comes to HFT. Number one, are they really contributing to something? What are they actually helping, right? I happen to believe that, the fact that people can actually make money from the market is because they are bringing something to the table. They must be doing something right for the market. That's why they can reap their returns, because they got paid to do those things for the market. Whereas on the flip side of it is that for every strategy, when you're actually bringing to the market, there will be some impact to the other market players or the market in general. So we have to look at some of these, limitations, I will put it that way, or sometimes maybe the general sort of concerns or even complaints about the HFT strategies. And then we dig deep to see, whether there are real grounds to be concerned, or that sometimes it's just some sort of a misunderstanding when we're looking at these strategies. So I took a little bit of time to go through the content because I think it's quite important for all of you to understand where I'm actually coming from. Now let's start with a definition. It is a very straightforward definition. I think if you read whatever articles that are talking about HFT, they will give you something very similar. But then, what I want to do is to stress on a few key points, which, as you can see, I actually, make them as in capital letters so that we can understand. So number one, a lot of the times people sort of forgotten about this is that the so-called high frequency trading or HFT is just a subset of what we call the algo trading, the algorithmic trading, right? So algorithmic trading is actually the big family, and the subset of it, which happens to be the one that is trading the fastest, is what we call high frequency trading. Now, not only speed, but usually when we're talking about HFT, we also imply that they are actually executing a large number of orders simultaneously, right? So yes, of course they have to be fast, but it's not just that they're fast. It's just that they're also handling a lot of orders simultaneously. And these two are very, very important factors for them to be able to make money out from the market. Now, how fast, you will ask? So by definition, you have to be trading, underneath a second to be qualified, so-called, as a high frequency trading. But nowadays, we are already moving way beyond the milliseconds. Some people are saying that we are already in the nanoseconds era, and some predicting that we may be even going to the picoseconds at some point. So just to have an idea how fast are we talking about? Millisecond, which is usually the starting point, it's basically 1/1000 of a second. And if we move on to microsecond, it's 1/1,000,000. And when we move on to nanoseconds, it's 1/1,billion. So technically, we're talking about you can trade up to 1,billion trades in 1 second. That's how fast it is. And then, of course, by definition, you can trade a lot of orders in such a short period of time. So for us human beings, it is so fast that basically, if we're just looking at the ticker and we're looking at the blinking of the changes of the prices, we won't be able to detect the trades. The trades are only detectable when we look back into the trading data. And these are what we call the tick data, because every tick is being recorded. Then we knew that, oh, actually there's a trade being done. And in fact, this were the complaints with some of the earlier days traders, not knowing really what happened, but then sometimes thinking, it's very interesting. Every time when I see a certain price and I want to make a trade, by the time I go into the market, that price disappeared, right? So what actually happened? What actually happened is that when we're blinking, already there are millions of trades being done in between the prices that we're actually looking at. So this is how fast it is, right? So we still remember, the movie Matrix, that's when Keanu Reeves are facing all these bullets coming over. And HFT, sort of a strategy is kind of like the main character, that all the bullets are actually seemingly coming so slow so that they can actually act between. And then this speed is within a second, right? So this is how we can sort of imagine it, how it is. So again, just to repeat, what makes HFT unique, it is number one, as a subset of an algo trading strategy, meaning you're using a large amount of data to actually come up with formulas and then rules to base your trading is, and by definition, it is systematic. Not only that, is that you can handle a very large number of orders in a very, very short time and doing it simultaneously. This is what we meant by HFT. Now, why I want to stress that is because over the years, when I'm talking to manager, we find out that this term is being used quite in a very loose way, right? So sometimes people define, high frequency as intraday, right? Again, obviously that's not so textbook, sorry, but then in some jurisdictions or in some culture, sometimes, managers, when they're talking about HFT, they are actually thinking, oh, if I'm trading minutes, that's actually HFT as well. But, in the true sense, we are talking about a speed of at least a millisecond, if not much faster nowadays. Now, after handling the definition, let's move on to the history, right? So everything started off by the NASDAQ going electronic. That's back in 1983. I mean, obviously, high frequency trading, started off from the States, and then it started to, move over to Europe and then Asia, and then slowly into the rest of the EMs as well. But it all started off with NASDAQ going electronic trading, right? That's the building block, because when things are being traded electronically, then you can move on to all your algo trading or your rule-based trading or your systematic trading. The second milestone was back into 1998 when the SEC authorized the other, trading revenue to come to the trading venue to come in to be able to compete with, the NYSE and NASDAQ. So there are no longer just two markets out there. There are plenty of markets, with the idea that we will bring on more competition to make the market more efficient. But interestingly, that opens up a lot of opportunities for arbitrageurs and also for the HFT, sort of strategy. Now, into the year 2000, HFT already extended beyond equities. We're going into fixed income, we are going into futures, derivatives, options, you name it, right? By the year 2001, another very important thing happened. It's the decimalization. So before that, they are trading a fraction of a price. So for example, it's 1/16, so every spread is around 0.0625. But when they go decimalized, they actually trade down to 0.01. So as you can see, suddenly the spreads are much tighter between the bid and the ask. That means that it allows more room for those trading fast to trade in between. So that immediately increases a lot of liquidity into the market, and it's also making the market more efficient because of the tighter spread in the market, right? So 2001 is a very, very important milestone, for us to move on to today's trading with, HFT and all that. Now, by 2007, another very, very important thing happened. There is the regulation NMS coming out in the States. Now, why this is very important? The original intention of this regulation is actually to make sure that out of all these different trading venues, there is an efficient pricing out there. So that means all the different venues, somehow they make sure that all their best bid and the best offer is being united into one very clear book, which everybody can see. And then the rule sets that you have to go into the market that actually offers the best price and then the best bid and the best offer for you to execute that. Originally, the intention is obviously to bring more transparencies and then more efficiency to the market, to facilitate the whole price discovery. But then, of course, that also opens up opportunity for NFT traders. And by, having or actually requiring people to basically execute at the best price, sometimes that best price may not be in the original market that they are in, so they have to go cross markets to go to that market to execute that price. But imagine if I manage to transact much faster, knowing very well where the best price is, there's a possibility for me, if I can move faster than you, to capture that price before you arrive. right? So this is not front running because this is not an insider information. It's actually based on public information, right? But it is just because I am, running faster. So some people call it outrunning, right? That I'm just basically running faster than you to be able to execute that best price. So when you look back, LMS doesn't really or didn't really start because they want to facilitate NFT. But then if you look back, that is really probably one of the very important trigger after decimalization for NFT to take shape and to be very, very active. And in fact, by the year 2009, which arguably was the peak of NFT activities in the States, it was said that, the exchange volumes, up to 70% of the volume is actually carried out, let's say by NFT, right? Okay, after that, what happened? Why then that was the peak? And then we are now, people arguing that we are probably coming back down to 50 to 60%. A lot of things happened. First thing, the flash crash. That was 2010, May the 6th. If you remember well, the Dow first went down 1,000 points. They went down first 300 something points, and then subsequently another 600 something points. And then within 10 minutes or so, they rebounded back 600 points. So the entire range was a 1,600 points dispersion in a matter of 10 minutes or something like that. So of course, that raised a lot of alarm bells. A lot of people obviously lost a lot of money, right? And then, of course, that created this, huge investigation as in, look, who should be responsible for this? What actually happened? And what about these HFT guys? Are they the one causing this? Now, if you look around, there has never been a very conclusive answer to that. Most of the people were saying that, the conclusion is that a lot of factors actually contributed to this. And maybe HFT is one of them. Now, a lot of the times when it gets down to those nitty-gritties, it's very, very difficult to really single out what actually causes that, right? But because of the nature of HFT, and then of course, a lot of people are pointing fingers to them, and then a lot of people are accusing them of causing this crash. So subsequently, there were a lot of scrutiny by different regulators. By the year 2013, the SEC started something called the Midas. Basically, it is a system that they can screen the market at milliseconds to be able to hopefully catch this sort of fraudulent activities, right? Because thinking about it, for somebody to first analyze the entire flash crash, actually it takes a lot of time. You know why? Because you have to really scrutinize every single tick data. Now, as I mentioned, if you're trading in the millisecond, if not the microseconds, every second you're trading up to 1 million trades. So if I have to scrutinize data of 10 minutes, you can run the numbers and you will know how much data we have to handle, right? And I think back then, maybe, data analytics and AI and whatnot, and all that was not actually as advanced as today. And of course, took them some time to digest. But eventually what they come up with is that, okay, look, it's not conclusive, but let's try to watch the market closer. And hence, by 2013, they come up with this screening to make sure that they would be able to look at trades at the milliseconds level, just to be on par with the speed of the HFT. And then hopefully they can catch some fraudulent activities. At the same time, Italy came out first in the world to introduce a special tax on HFT. Basically, what they're saying is that any trade that happened beneath 0.5 seconds, I will charge you 2 basis points. Some other countries or some other areas like Hong Kong, we use a more basic way to defend it. Basically, we just make sure that we have a big enough stamp duty. As you know, Hong Kong, one side is 10 basis points, two sides 20. So of course, if you add it all up, it's already a very natural defense, you know, if you are really worried about HFT guys coming in and causing trouble. Because basically, I think with 20 bips on both sides, it's very, very difficult to make HFT lucrative or even making money in this part of the world. And last but not least, of course, we have to mention the book by Michael Lewis that's called Flash Boys. If you guys haven't heard of the book or haven't read it, and I really urge you to read it. Number one, okay, don't take it really as true story, because nobody will tell you whether those are true stories or not. But at least I personally find it a very interesting and comprehensive way to explain, you know, what actually happened, especially in the institutional world, right? So the story goes that it all started off with some of the banks, some of the head of trading of a bank, facing the problem that I just mentioned, that every time they try to get a trade done, and they are really sure that they see that price on the screen, every time when they go in, they miss that trade. That's started the thinking process that something must be very, very interesting happening. First of all, they thought it's some sort of system error, and then they dig deep and then they find out, oh, there are these guys called the HFT operators. They're operating in between, you know, in between human eyes, basically. Right. So I urge you, if you're interested in this topic, to read this book. Again, you know, please don't think that everything it says is 100%, you know, the actual reality, but I think it is a good direction to understand, you know, all the dynamics, you know, inside. Okay, now let's get down to the strategies, which are obviously the most important, I think, the ones that you guys are more interested in. Look, let's all start up with the basic, right? And this is the understanding of most of the people. We can debate till the end of time whether this is really true or not, but then it's well documented that, you know, the early days of HFT all started off with some very basic market making strategies, right? So when we say market making, basically you are trying to trade the bid-ask spread. So being a typical market maker, you know, you put on your best bid and you put on your best offer. And then people will come to you, either lift your offer or then they will hit your bid. And by doing that, what you're doing is actually providing liquidity to the market. People want to buy and then they need somebody to sell it to them, and you are the seller. People want to sell, they need somebody to buy it from them, you are the buyer. So this is the original nature of, you know, HFT. And believe it or not, they are actually acting as a liquidity provider to the system, which is quite different from what most of the people understand. People always thought that they are actually a liquidity taker, and that's why they make things worse. When the market's going up, they make it go much faster. When the market's going down, they make it down much faster. But then the very nature at the very beginning, or at least this is what that is known to most of the operators, it was actually a market-making strategy. And I think the firm that makes it very famous is Renaissance Technology. And then, of course, things evolved, right? You know, as we trade faster, and there are better algos and there are better, you know, sort of technology. Yeah, we come up with other stuff, right? So one very common thing that came out after, and together with the development of AI and machine learning, is what we call events trading. So basically what that is that I use some sort of machine learning technique called natural language processing, NLP, which is the building blocks of today's LLM. But let's get back to just NLP. Basically, I use NLP to read, you know, I will teach the computer to read all the information that actually got thrown in, you know, earnings announcement, news flows, you know, you name it. Anything one can actually pick up from the market, you know, from the machines, from Bloomberg, Reuters, whatnot. They digested it and they immediately suggested a trade, you know, to go into the market. Now, being HFT, obviously, and armed with NLP, by definition, by the time you execute the trade, human traders are probably still digesting the news. Okay, so this is how you gain the edge. And in events trading, combining with the technology, combining with the speed, chances are that when there's major news breaking into the system, you are the first one to be able to react, right? So that, again, pretty simplistic, pretty straightforward. There's no magic there. It's just that you need good machine learning techniques, and then you need, fast system. And then we go back to something even more basic. It's what we call statistical arbitrage. Statistical arbitrage, for those that have been studying, sort of typical algo strategies or hedge fund, equity market neutral strategies, they will know that this is nothing really, really new. Basically, I'm just basing on historical price data to predict the future. And my prediction is basically betting that history will repeat itself. So I look at the historical data, I look at the ranges, and I look at, let's say the dynamics, and then I basically trying to make a prediction into the market that when something similar happening again, this will be the price movement. And of course, in the HFT world, I can't just use daily data. I can't just use hourly data. I have to use tick data. So of course, statistical arbitrage in the HFT world, it's of course much more cutting edge. So you are trying to capture the slightest deviation from, let's say the historical mean, and then you're trying to execute it, faster than the others, right? So that's basically what that is again. The fourth one, also very simplistic. It's related to, let's say the RAC NMS that I was talking about. It's basically trying to capture the price differentials across markets, right? So, for the same security, for the same piece of assets, it got traded, around 10 different trading venues. And of course, as simplistic as you go and look for the lowest bid, and then you go and look for the highest offer. And then you're trying to arbitrage in between, right? Sometimes, let's say the highest offer, the offer of a market is actually lower than the bid of another market. Then, of course, then you can make a lot of money. But then, of course, now with, systems all getting very fast, and then with the technology also much more, commonly used, these sort of opportunities are actually getting less and less. So you see that these type of, trading nowadays tend to move into the more illiquid markets, right? Emerging markets, for example, or maybe even, let's say, the crypto market, right? Which we're seeing more of these cross markets arbitrage. But then if you dig deeper, you will also understand that, for these sort of more illiquid markets, they have their own issues, at the back end, no matter on the settlement side or also even the API, the speed of that. So sometimes the arbitrage exists for a reason. So before you're getting too excited to jump in and so to capture that, to make sure that you eventually can successfully settle that trade, right? And then, of course, there's also things that should be pretty, let's say standard for people that have been, trading arbitrage strategy. It's arbitraging between futures and cash or options and cash, right? And my understanding is that this is quite a common strategy also in India. And then because, you have a very deep futures and options market. And then that's why, let's say there's a lot of activities. A manager told me the other day that he believes HFT activities is now up to 65% of the Indian market, right? I mean, I think you guys are the better one to tell me whether you think this is true or not, but this is according to him. And that's why he was saying that that's why some of the derivatives market, the turnover is actually the highest in the world right now, thanks to the activities of HFT. Another one, also quite straightforward, is what we call ETF arbitrage or ETF market making. Actually, it all started off with ETF market making, right? When ETF are being listed, most of the exchanges will make sure that there are market makers out there to make sure that the ETF is actually not trading too out of whack with the underlying NAV. And then, what started off with market making, But, by the time that they actually have some better system, and then they have, let's say better algos, they may be able to actually arbitrage any very short time, inefficiencies in the market to capture the difference. So if you look at some of the exchange of sort of authorized market maker, you will find some very familiar HFT firms in it. Last but not least, it's probably the most controversial one, is what we call momentum ignition, or some people call it flash trading. And this is the one that got blamed most of the time, blaming that the HFT guys are actually going into the market to make things worse. When the market is, rallying very strongly, they make it going up even faster by trying to get ahead and trying to ignite the emission, the momentum, meaning that to trying to attract the other people to chase the market at the same time, and the other way around when you are dumping the market. In a certain way, I think it is quite safe to argue that I'm sure there are strategies like that to take advantage of some traditional long-only flows, right? It's just normal, right? So you can detect by suddenly an uptick in turnover, and suddenly, you're seeing volume picking up, it's, you got every sign that a major, institution is accumulating in the market. Then, of course, then they will trigger some sort of, the HFT to trying to move ahead and then trying to jump the gun. But then what I'm just trying to stress again is that, remember, what's the objective of an HFT strategy? Is to make money, right? So I don't believe there are strategies going into the market just for the sake of stirring up, these sort of momentum, without knowing that there's an exit. Because at the end of the day, you have to get out of that trade also to be able to lock in your profits, right? So just by blindly chasing the market together with everybody, or creating that sort of atmosphere to try to drag in the other people, just for the sake of it, doesn't really make sense, right? So you got to have the exit strategy in place as well. And a lot of the times that's also very algo based. So a lot of the times they may seem like some sort of a momentum ignition, but then actually they have, sort of data and rules based on that, thinking that, okay, if in a certain period of time, turnover pick up in such a way, or market is trading, a certain standard deviation, let's say away from historical mean, then they come up with the suggestion that there may be some sort of momentum in the short term. But if you think about it, the shorter a time frame, actually, the less correlation one can actually find. And a lot of the times, when you're trading momentum, it's actually, you need some sort of correlation, and usually these correlation, you draw the conclusion from historical data, right? Whereas market making is something which is a little bit more, sort of normal when you're trading in the short term. When you're trading in the short term, at some point in time, there will be some slight supply and demand sort of imbalances, which means sometimes the supply will overwhelm the demand or the other way around. And that causes the price to deviate from the mean. And that's when the market maker comes in to provide liquidity to actually brings the equilibrium back, right? So even though I may sound like that I'm more pro the HFT guys, but then if you ask me, I find the market making argument a little bit more sort of convincing. Momentum happens, of course, algo trading, people that are familiar with CTAs, you see they are short-term CTAs, but then when we're talking about short-term, we're still talking about maybe, days, right? Sometimes maybe intraday. But then when you're talking about in split seconds, I find it a little bit, sort of dubious to argue it that way, which then means, to what extent HFT really contributed to flash crash and all that, I have my own doubt, right? I think if in anything, they probably were on the other side, trying to make, sort of liquidity to the market. But then, of course, there are a lot of other elements that chases it. So maybe they keep on providing liquidity, but they keep on rolling it down. And then, as I mentioned, not every single HFT trade will make money, right? So to be able to protect their capital, they have to cut their losses as well, right? Don't think that the hit rate of a HFT strategy is close to 100%, right? A lot of the times, maybe it's also just in the 50s or the 60s, you know. It's just that because they hold their stock very, very tight. And that's how they can make money in the long run, right? But just run basic mathematics. Even if they can have 52% hit rate, but if they're trading a million trades a second, you can do the calculation, you know, you're still decent profit, right? You know, so that's basically, it's a number game, right? Basically, they're playing a number game, a probability game. Okay, so let's move into some of the usual argument, sort of pro HFT, right? So I already mentioned quite a bit. Of course, the original idea is to improve liquidity. I want to bring in market makers to provide liquidity when everybody is taking liquidity from the market. And by doing so, I can narrow the bid-ask spread, and then I can enhance, and this is really traditional finance of the use of a marketplace, is that I can enhance the price discovery and the market efficiency. And by doing that, because I'm taking the other side of the trade, I'm reducing short-term volatility. And then with the liquidity, I'm lowering the transaction cost. And then with more and more investment going into this, I'm also, helping the economies of scale in trading infrastructure. And then, of course, it's also encourages automation and mathematization on the buy side. Today, when we see so many algos and systematic and quants trading in the market, is probably also because of the proliferation of the HFT strategy. And that leads to more innovations of technology. Human capital development, we have more and more programmers, engineers, and all that moving into the space. Traditionally, you will never have put in the two. You always think that people should study economics and finance before you go into the space. But then now, actually, I think our industry is employing more system engineers or engineering background than those with traditional financial background. And last but not least, of course, trading so many times, you bring in extra revenue, let's say for the governments as well. So these are the pros, right? I mean, it's very well argued already over time. Let's take a look at some of the usual sort of complaints, concerns, or I would like to use the word like limitation of the strategy. Now, first, let's try to tackle this argument about unfair speed advantage, right? And understand that it is very common, especially among the retails. Look, it's unfair. Why those guys can trade so fast and then they always slow my trade before I can do it, right? So that goes back to my original argument, and this is just my perspective, right? You don't have to agree or disagree with me. That is assuming that you are doing exactly the same thing these HFT people are doing. But number one, if I think HFT primarily they're still running market making strategy, then I will challenge, especially the retail investors, are they in the market trying to provide liquidity, or are they actually in the market to take liquidity? I find it a bit hard to believe that they are going into the market with a very, very strong sense of, oh, I'm going to put bring in liquidity, meaning I'll be a contrarian, I'll be taking the other side of the trade. So that's number one. Number two is, don't forget, all the HFT participants, they are actually market operators. Whereas for retail, I don't think anyone of the retail, are market operators themselves. They go for a broker, right? Nowadays maybe it's an electronic broker, but they still go for somebody. And then a lot of the times, and you know what, and maybe I'm biased, but then a lot of the times the retails got screwed, not so much by the HFT guys, but actually by the brokers, right? The more the brokers are saying, look, oh, I don't charge you commission. Oh, I give you this, fast, venue to go in. The more, you should be suspicious, right? I mean, no broker will be in this trade for running a charity, right? So the fact that they don't charge you commission, the money has to come from somewhere, and where is it coming from, right? So again, I mean, I'm not trying to just, blindly defend HFT, but then sometimes I think when people are saying that it's an unfair speed advantage, we have to think whether it is really a competition between an individual participant in the market and an HFT guy. Because number one, HFT guy is actually a market participant, as in they have their own direct, trading route into the market, whereas most of the retail are trading through brokers. Number two, it's of course, as I'm saying, what is the intention of the retail, investors going into the market, right? If you have a very conscious mind that, oh, actually, I'm in here to be a contrarian, to be a market maker, maybe, right? But then as far as my understanding, most of the retails are very momentum trading. So that's a little bit, say my perspective about this, right? And then of course, then is the preferential treatment thing, which it's well documented that some of the exchanges actually give extra, sort of discounts, or they will actually give them better, location, or what we call the co-location of their mainframe to get closer to the exchange if they've proven to be generating a lot of trades for the exchange, right? True, it is preferential treatment, but then again, these guys are market participants. They are actually, a license, or owner of trading directly in the market, right? So I think it is just normal, for that to be given some sort of treatment. Whereas maybe one should ask their broker, right? Why don't you get some sort of preferential treatment from the stock exchange and then share it with us when we are using you, right? Most of the time, I would say they probably get some preferential treatment, but then they probably don't share it with their investors or with their customers. So the third point is about, a flash crash, whether they worsen the market stress. I mean, I can't completely rule out that some of the participants of the HFT space are actually running a momentum strategy. But then I still think that, if you actually wait out most of the strategies that are being carried out, I will still argue market making and arbitrage strategy as, let's say the more common strategy. Simply because I personally think that a momentum strategy, your hit rate, especially in such a short time frame, is very, very, very difficult to gauge. Because in such a short time frame, it's very difficult to come up with any conclusion about the certain correlation of a trade, right? Whereas, of course, if you're trading days and weeks, it's much easier for you to make that argument. Now, one limitation is that I find it very challenging as an allocator is most of these strategies are very capacity constrained. Have you ever heard of an HFT operator going into the market actively looking for investors? Very seldom, right? By definition, if I'm trading in seconds, actually, I can find brokers to offer me nearly close to infinity sort of leverage because they know that it will be squared out, let's say in a matter of a split second. And most of the time when you hear people really needing some money to trade, it's because they need the money to put down margins because a lot of the exchanges are increasing the margins, of some of the products. And so usually when you hear somebody actually raising money, that's probably the case. But then again, I will argue for the really established traders, the HFT traders, I doubt that, I doubt why they can't come up with that kind of money. And I'm not talking about a lot of them. I'm talking about maybe in the space of $10 to $20 million only, right? So, I sincerely doubt, when you hear an HFT operator coming to you and trying to raise money from you, I will be very, very suspicious. Okay, black box, usual argument, right? Oh, I don't know what's in there. I try my best just now to trying to explain those strategies to you in very simple terms. Some of you may have doubt. No, it's not that simple. It's much more complicated. What I will say is maybe when it comes to risk management and execution, it is much more complicated than what I mentioned. But when it comes to the actual objective of those strategies, it's actually as simple as that. As I mentioned, the more complex the strategy, the more moving parts, the more risk actually is associated with. So I doubt a lot of the very successful, sort of HFT strategies are actually very complex. You go back into Rentec, right? The first successful known, and then they make it very, very open. They say, well, look, it is what it is. It's the market making strategy. That's why, it's very capacity constrained. And that's why that they have to close down the medallion fund and then return all the money because, they want to keep the capacity for themselves, right? Okay, last but not least, I want to touch on those that are the big no-no. And really, these are what we call the illegal strategies, right? One is called spoofing. Spoofing meaning that you pretend that you are, bidding or you are offering, and then, in a very, very split second, you take them all away just to give a false, sort of impression to the market. The other is layering. Here you put down real bids or real offers and you put down layers and layers and layers. But actually what you're trying to do is to do the trade on the other side, right? Because by putting the pressure on one side, you actually forces the price to go to the other direction. Last but not least is quote stuffing. Quote stuffing is basically sending a lot of orders in a very short period of time. Yeah. So it's kind of like the DOS attack, it's a denial of services. And you basically, it's just delaying your competitors. And at the same time, you're trying to buy time to get, the trade that you want to get done. So I understand that I overrun a little bit. I really want to leave more time for Q&A. So maybe I'll stop here and then, I will open up to the floor.
Thank you so much, Daniel, for sharing your learnings and experience with us today. It was extremely insightful to listen to you. And I think that this topic was also a bit new for a lot of audience, I suppose. And that's something which would have been very, very helpful for them. And now we'll take some questions. So I'll begin with Ishwar Jindal. He's asking a large number of trades in short time. And what about the size of trade? That is notional value. And is that also large, or is it small value trade, but large in numbers?
No. Yeah, good question. Yeah, by definition, these are all very, very small trades, right? Because once that trade size getting bigger, you then become, impacting the market. Then the market will already be, so then you become a liquidity taker in the market. The bigger that trade, the more impact it will have into the market, and then you don't want that, right? So it is a very small, maybe the smaller size that you can do, but then you just do a lot of them. So that's like in that little time, so you can actually get the trade done. So that's the thing. But it's a good question. I mean, I think it's fair. Yeah.
Thank you, Daniel. Next question is from Rishabh, and he's asking that sometimes because of the taxes, which could be different from one market to another, like for example, you might have a stamp duty, or you might have taxes on transactions. So how does that impact the trade? So let's say, for example, if you look at Hong Kong or maybe the other markets as well, it might be possible that you can't make money because of these frictional costs. And that's something which you have any view on? And are there any regulation which can impact trading in HFT?
No, I mean, as I mentioned a little bit earlier, I think that's the most effective way if the regulators want the HFT away from that market, right? And that's what, and honestly, we have been lobbying, our exchange as well, is that, hey, look, if you want more liquidity, you're complaining that we don't have liquidity, just take away the stamp duty. And then, why they're not doing it, right? And that there's a reason for that. So again, I think sometimes if we put ourselves onto the regulator side of things, and of course, they have other consideration as well, right? So it's easy to always say that, oh, I want an efficient market, but then, there are balances. So yes, I mean, definitely. And then we are trading just ticks, right? 0.01 basically. So, if you put in like a 10 bips on one side and forget it, what kind of return? Nothing. Yeah.
Right. 0.101, and you can lose millions, you can make millions.
Yeah.
So this question, actually, the next one I also wanted to ask, and I think it's a very interesting question. Sampada Suresh Dali, she's asking, how does an individual trader perform HFT? Are there any software applications available for individual investors to do HFT, or it's an institutional investors game and retail investor or individual investors don't stand a chance? Like, what's your sense on that, Daniel?
Very good question. I actually have a very strong feeling about that. I think as a retail investor or individual investor, I think they should understand that, this is really an institutional game, and this is really a very cutthroat and then, sort of an arms race type of game. So unless you are an individual investor so big that you become a market participant yourself, you manage to get a license to trade directly into a market, and then we can talk about whether we should deploy some fundings to actually build that sort of strategy. The time that you are still using somebody or a broker to go in, if anything, if they even offer you that, I doubt, let's say bulk of the money is being made by you, it's probably made by them. Right.
So true. So true. Thanks, Daniel. Next question is from Naveen. And the question is that given the large number of trades simultaneously happening, and it might mean that, again, it's a different variation of the same questions which was discussed and which you have also talked about, but it could mean that very high trading and transaction cost. Is there any specific differentiator HFTs can create to overcome that handicap? So like, it's something which is uniform for everyone, or like you can do something to address that challenge?
I think number one, very seldom you can carry out HFT very effectively in illiquid markets, right? So by definition, you need a very deep market to be able to do that, right? So instead of saying overcoming that, maybe it's more like the selection of the market first. So that's why, even though we talk about HFT, but if you really looked around, there are only a handful of markets where bulk of activities is actually happening, right? There are a lot of markets that you hear very seldom, there is a very high activity in HFT. And in fact, that's why I'm saying, that's why I know why this topic is very popular now in India, because, look at the turnover of your market, especially the derivatives market and all that. It's a very fertile ground for HFT operator. So I would say, instead of thinking of how you can get around it, it is what it is, right? Basically, you're just trying to up that one bit or whatever, but in a very, very short period of time, in between human eyes, really. But you need a deep market to do that, right? So I will say, instead of thinking of whether I can get around it, maybe you just have to pick the right market to do it.
We have a lot more questions in the queue, but unfortunately, we'll take just one last one. This is from Yan Wang. And the question is that, how do we know beforehand that which HFT strategies will outperform or last? So like your job to select a strategy or manager, like what could be the steps in due diligence, and how do you figure out that, okay, this is going to work and this is not going to work? Of course, sometimes there might be challenges, type 1, type 2 errors may again happen, but like in your way, how do you do your due diligence to understand what is going to work and what is not?
I mean, honestly, very difficult to do due diligence on HFTs. Number one is because you're dealing with a large amount of data. I doubt any HFT firm will go around and do an audit of their trading record. The best audit, really, and this is what some of them were telling me, say, look, I did all my trades through this account, and I started with this amount, and now this is the amount I got in the account, right? So those numbers must be real. And then you can check, I didn't take any money in, I didn't put in more money. So this is the outcome. So yes, I can have some certainty about the kind of return they made, but it will be close to impossible to understand how they make those money, which is, as simple as that, right? So honestly, I think for institutional allocators, HFT is probably not the thing that they will pick. They just simply can't explain it to the board or to, their stakeholders or whatever, right? So you see most of the time it's maybe some family officers, or a lot of the times, honestly, they don't need your money, as I mentioned, right? They really don't need your money, or they need your money just to put in there as a margin. So of course they won't give you a very good cut because of that. So.
Thank you for such an honest answer. Like your humility in admitting that not every time
Mm.
you will have all the answers and 100% certainty about your calls. Thank you so much, Daniel. This was fantastic. Like, thank you so much, Daniel, and it was a pleasure to listen to you. And I hope that our audience would have found this conversation and this presentation very, very useful.